Can rising interest rates devalue existing Treasury bonds? Imagine holding a bond that pays a fixed interest rate, and then suddenly, interest rates in the market start climbing. What happens to your bond? You might be surprised to learn that rising interest rates can actually lower the value of your existing Treasury bonds. This is a key idea in bond investing and especially important for those seeking passive income through bonds. Treasury bonds pay a set interest rate, called a coupon rate, which stays the same until maturity. When market interest rates go up, new bonds are issued with higher coupon rates to attract investors. Your older bond with its lower rate becomes less appealing because investors can get better returns elsewhere. To sell your bond, you might have to accept a lower price, which is called a discount. This drop in price is what we call devaluation. Think of it like a seesaw. When interest rates go up, bond prices go down. When interest rates fall, bond prices go up. Bond prices adjust so that their yields stay competitive with new bonds issued at current rates. For example, if you own a Treasury bond paying 5% interest and new bonds are issued paying 6%, your bond is less attractive. To sell it, you might need to lower the price so that the effective yield matches the new higher rates. Conversely, if new bonds pay only 4%, your 5% bond becomes more valuable and can be sold at a premium. The impact of rising interest rates on bond prices depends on how long the bond is until maturity. Longer-term bonds tend to see bigger price swings when rates change. This is because they have a higher duration, which measures how sensitive a bond's price is to interest rate changes. For example, a 10-year Treasury bond with a duration of about 9 years would lose roughly 9% of its value if interest rates rise by 1 percentage point. If rates go up by 2 percentage points, the loss could be around 18%. Bonds with lower coupon rates are more affected by rising rates than those with higher coupons. For instance, a bond paying 2% interest will lose more value when rates increase than a bond paying 4%, assuming all other features are the same. For passive income investors, this means timing is important. If you sell your bonds before they mature during a rising rate environment, you might face a loss. But if you hold until maturity, you will get back the full face value, regardless of how much interest rates have risen. The higher interest payments you receive over time can help offset the loss in bond value if you sell early. Currently, Treasury yields fluctuate based on Federal Reserve policies and inflation data. When the Fed signals possible rate cuts, yields fall and bond prices rise. When inflation remains high or the Fed keeps rates high, yields go up and bond prices fall. Rising interest rates can be a challenge for passive income from bonds because existing bonds lose value if you sell them early. But they also present an opportunity. As bonds mature or new bonds are issued at higher rates, you can reinvest your money into higher-yielding securities. Over time, this can lead to increased income streams. Understanding how interest rates and bond prices move together helps you manage your bond investments better. Knowing this relationship allows you to plan whether to hold bonds to maturity or adjust your strategy based on market conditions. This knowledge is vital for building a steady passive income from bond and fixed income investments.